Hello and welcome to the Weekend Investing Daily Byte of 14th of August. Tomorrow is Independence Day, so we will have a market holiday. Markets were very dull ahead of the holiday. There's one more session this week. There's a lot of data coming from the US, so it's very unpredictable how the next 2 days the international markets, the global markets will move. And hence, I think people were very cautious in terms of going into tomorrow's holiday. Uh, as I said, there was hardly any movement in the market, so there's not too many sectors to talk about. But there was a story on Economic Times about how mutual funds and FIIs are reducing their holding of PSU stocks. Should we be doing that? Uh, Basis, whatever is the narrative out there, what has been the past of the PSU stocks? How much have they run in the previous historical runs? We will go through all of that in the second half of the video. Please do subscribe to the channel if you haven't so far. Thank you so much for all those who have subscribed, and for many of you who haven't so far, please do subscribe. Markets going nowhere actually, plus 0.02%. Absolutely still water. I mean, this is surprising actually after yesterday's breakdown of the flag that we had here. Today's session was a very insipid and quiet session. Maybe we will have more action towards the downside in coming sessions, but today was not a indication of that. In fact, today was a lot of consolidation within a very small range, which is always good news. I mean, after a trending move, if you have small ranged candles, it is increasing the probability of trend of change or change of trend, I suppose. Uh, Nifty Junior also sort of not really breaking down, uh, going down below yesterday, but coming back up and closing very much near yesterday's close. 0.05% is the net gain today. And you can see the support here that we've drawn is substantial support here that is not yet breaking. Mid caps were losing some ground. So mid caps have lost 0.6% today. So there seems to be a very rough head and shoulders pattern getting formed here below 20,200, 300 is going to be a risk that pattern getting started. But till then, I think we are still safe on mid caps. But yes, they are more sluggish than the large caps. And the similar story was playing out in small caps, where small caps were also down nearly 0.6% below yesterday's close, and also hurtling towards this last sort of support below which there will be a significant amount of consolidation period if that goes there. Bank Nifty is gradually inching down 0.21%, and it's at a razor thin edge where the previous low 5 days back was made. In the next session, if we break that low, some algorithms will certainly try to break the market down, as this is the most recent pivot which is being watched. Uh, this gap here that was made has not been fulfilled at all. This attempt was failed. So the only hope is that we make a double bottom here and start upwards. Otherwise, we seem to be uh, drifting downwards, if not really falling downwards in a big way, minus 0.21%. Heat map mostly red, but IT saved the day. TCS up 2.3%, Infosys 1.4, HCL Tech 2.1%, Wipro up 1%. The main damage was in Coal India minus 3%, ONGC minus 2%. You also had some damage in Hiromoto, in Ultrasemco, JSW Steel, Tata Steel. So metals, commodities, and oil and gas is where some of the damage happened today on the Nifty. And if we look at the Nifty next 50 chart, you see a lot more green. So some mid caps, some smaller large caps did some gains. So Adani was one of them, ABB, Bajaj Holding, Chola Finance, ICICI General Insurance. Some of these stocks were looking up. JSPL was also looking up despite other steels sector going down. Major losers remained Adani Green and Adani Power. Adani Total Gas also went down. Varun Beverages was down, Marico was down, TVS Motor Pidilite So no major losses as such, but it's just a couple of percentage here or there was the movement. As I said, overall market has not really moved today. Sectoral trends, metals, as I mentioned, metals and public sector enterprise stocks were the biggest hit in sectors. Commodities also following suit. So there was some news that states will be able to now effectively charge taxation on metals and mining companies, and that caused some flurry here. Pharma also some profit taking today, minus 0.8%. Some of the pharma charts actually are starting to look very, very good, especially mid cap pharma. So I'm reasonably hopeful on pharma, and you can see that in the last 3 months, pharma is the number two sector in terms of performance. IT is number one. So you can see that there is a very gradual but obvious shift towards defensive sectors. FMCG has also done 11.4%. Consumption stocks are 11.5. These are all pretty much defensive sectors, and the higher risk or risk on sectors, metals, energy, real estate, they have taken a backseat, especially on a monthly basis and somewhat on a 3 monthly basis also. Autos were spared today. Nifty, of course, was flat. Consumption was slightly up. IT was up 1.6%. The rest were in the middle, not really going here or there. IT index has bounced back. In fact, this is the only index which has really covered the gap that was created last week. So IT is definitely back in action. The gap is done, and hopefully now it will move forward and again challenge the previous high in due course of time. So these are signals that what is having the relative strength in the market right now. Uh, in on a longer basis, also you can see that is sort of a cup and handle pattern is there on Nifty IT index. It is sort of retracing and taking support at these previous highs. So CNX IT is probably one of the best charts that is there in terms of the promise in the very short term. Stock Spotlight EPL Limited up 11.97%. So even in a dull and drab market, you have stocks that are going up rapidly. Within a couple of months, the stock has gone from 165 towards 250. On a longer term basis, also you can see very clearly that it had initially made a sort of a inverted IHNS pattern, which had a very nice move between 2014 and 2021, and then it has been sort of in some sort of consolidation here, and it is ready to really take on the previous highs going forward. The topic for the day: get out of PSU stocks seem to be the narrative on the bigger media channels. But let's first look at what the public sector enterprise index has done. So if you see this chart is for the last almost 30 years. And you can see that there was only one big rally in public sector enterprise stocks, and that was 2003, or rather 2002 till about 2008. And we went from near 300 to near, you can say, 5,000. Uh, so almost, more than 16 times was the gain in this rally, which lasted for almost 6 years. Now, if I look at this current rally, and even if I take the bottom here at 2000, we are about 5 times higher from the bottom, the recent bottom in 2020, and we are about 4 years. If this were to repeat, I mean, we are going much, much higher, but you can never say if this will repeat or not. But I'm just showing you what historically sometimes the past performance can at least give you confidence that what is possible. Instead of us thinking that it has gone up 5 times, so hence it can't go up because nothing else is going up at that pace. These are sort of regime changes which happen. So in if you see this period of 6 years, 6 years and 16 times gain, and then for the next 14 years, uh, almost nothing. So 6 years, 16 times gain, next 14 years, zero gains, and now in the last few years, again a sharp increase. So you really can't say where this will stop. You may think that there may be maybe a 6 months of a hiatus like this, or 12-month hiatus like this. That is always possible. But is this rally ending as of now? I don't know, and nobody can really say what is happening. Similarly, for PSU bank index also, where the rally went from nearly 800 to about again 5,000. So about six times here. And here in PSU banking, we've gone up almost a similar uh, manner. So this is somewhat very similar to what happened earlier. And right now, on a 3 month basis, we have just given up a very small part of the gain. When we compare the public sector enterprise index and the public sector banking index versus Nifty 50 post COVID, we see that the CNX PSE index has gained 361%. Public sector banks have gained 330%, while Nifty has done 142%. So it's a huge beat, especially since June of 2022. And we are approximately 2 years into this super performance by these two sectors. Whether this super performance can last for 3 years, 4 years, 5 years, 8 years, nobody can really say. So to throw the baby out of the bathtub just because some gains have come is probably, in my view, not the right way to look at it. However, mutual funds and FIIs are turning bearish on some counters. So the Q1 shareholding pattern has revealed that mutual fund has sold stakes in 28 PSU stocks. FIIs were bearish on 30 such counters, and there were 13 government stocks that were sold by both of them. So these stocks, for instance, HAL, mutual funds have reduced their holding by 0.9%. FIIs have reduced their holding by 0.74%, and retailers have increased their holding by 1.3%. Bharat Electronics mutual funds have dropped it by almost 2%, FIIs by 0.13%, and retailers by. But the common factor here is that both institutions, foreign as well as domestic, in these stocks have reduced their holdings and retailers have picked it up. That fact need not necessarily mean that these stocks have topped out. See, what we need to be very, very clear about the fact is people who are managing mutual funds, people who are managing FIIs are as human as you and me. Some of them may have some possibly higher knowledge levels or more experience level, but over a period of time, 80% managers don't even beat the index. So let's not forget that fact that these are human bodies sitting behind these institutions and they are taking a decision based on their discretionary thought process, and which may or may not be right. So, and they have a lot to answer to their investors why you are holding, a company which is 60 times earnings, for instance, and to showcase their intent that they are gradually chipping away at the profits. They probably are also, reducing their exposure and so on and so forth. So there may be a lot of stories behind why there is a change of exposure. Maybe they are reallocating within public sector stocks to other stocks which have not yet run up. So while this is seeming as if FIIs and mutual funds are dumping PSU stocks, but it is not so. I mean, the percentage changes are minimal actually from that point of view. Uh, so, for instance, HAL, mutual funds have reduced stake by 0.9%, FI by 0.74%, and results are good. MASDOC, recent results, very good. RVNL getting orders day by day, good results. So, you don't know how much discounting is already done for the next 5 years of orders they're going to get, uh, you know, or is it going to be even further up after a hiatus of some break in the flow of funds towards that. So to read these headlines is one thing, but to really somehow create a model on how to react or how to exit whenever it is possible. For instance, the same article in Economic Times also quotes that as a whole, public sector units remain reasonably valued. So CPSE index is trading at 14 times price earnings trailing 12 months compared to Nifty 50 of 23 times. So what is more at risk right now? Other Nifty stocks or these PSU stocks? You can decide. So PSU, because of that 14-year, what should I say? Uh, Vanvas, 14 years of Vanvas that PSU has had. There is no confidence on PSUs, and because they have gone up like a rocket in the last 3 years, people are possibly feeling that that 14-year can start anytime soon again. It may so, or it may not. I mean, how do you decide? So I want you to do is to send us your thoughts on PSCs and PSUs. Just the fact that something has gone up suddenly is no reason to sell, in my view. You know my thought process about stocks that are going up. Our business is very, very simple. We buy stocks that go up, we sell stocks that go down. So from that point of view, something that has gone up and is just about, let's say, 5% from all-time high, 2% from all-time high, is still a very good candidate to go up further high. If something is dropping from there and has dropped, let's say 20, 25, 30%, then it is giving an indication, then maybe, there is not enough support in that stock. And on each drop, there are not enough buyers coming into the market for it. So these are some sort of, thumb rules that you can make if you are a discretionary investor, or, how to look at stocks that run. For instance, um, Nvidia ran from $100 to $1,000. At every point, people were questioning, is it too much? Is it too much? Is it too much? And it is still there. Maybe it will come down at some point of time, and when it does, people can always get off. But usually, what will happen, and this is because of behavioral issues investors have in the market, is that they will get satisfied very easily. So I have 1400 rupees and my 100 becomes 200. I said, okay, it's enough for me. I'm getting out of the market. Maybe that stock is going from 100 to 1000. Why do you want to give up that gain just because you are feeling scared? So anything that is going up, don't be scared of it. Anything that is coming down, please be scared of that. It is reverse in most people's mind. Anything that goes up, people are scared that they will lose the profit. Anything that comes down, they're very confident that it will go up again. So this is a psychological, uh, in my viewpoint, a major error in most people's thinking, that stocks that are coming down are good and stocks that are going up should be feared. I hope and wish that whatever content we create and whatever we have been doing for last 8 years, for some people at least, this paradigm shift needs to happen, that you should start liking stocks that go up and start hating stocks that go down. Let me know if you have achieved that. Thanks. Bye.